Good morning, Energy Funders investors. It's Reed Stiles, VP of Upstream. I'm so excited to bring you two amazing projects with Houston Energy. Now, we've done one deal with Houston Energy to date. It's called the Theol Prospect. It was EFVC 14. It was a doozy. It took a while to get the drilling done. We raised in 2017 and part of 2018 because there were a lot of changes to the project. The land and legal aspect was really complicated. The surface location was complicated, but of course it's turned out to be our best well to date. So with a lot of adversity, if you can fight through it and if you can make these really complex deals work, you can find substantial amounts of resources. And that's what has us so excited about these next two projects. I want to give you a legal disclaimer really quick. This is not an offer. All offers will be made through the project page at energyfunders.com. That's where you can log into our private placement platform. You can review the deal terms, you can review the disclosure memorandum, the technical details. This video will be located on that page. And if you have any questions, always feel free to reach out to us. However, everything should be enclosed on the project page needed to make the investment. This investment is for accredited investors only, and your accreditation will be done through our platform. So I wanted to quickly turn the presentation over to Casey Minshew, who's our CEO, because it's a little different than our current projects. And so I want to introduce Casey at this point.
Hey, Reed, thank you very much for letting me jump on here real quick. And the investors, thanks for your interest. And Jared, I really appreciate you being here. A couple things I just wanted to cover. The business carries risk, and we all understand that. Most of you have been investing with us for a long time, and you understand that. What is different about the projects that we're looking at here with Houston Energy is that these are big wells, meaning that, there's a lot of things that are encumbered with those wells. One's 17,000 foot, one's 20,000 feet. These are different type of wells in the sense of requirements from an investor and expectations. The good news is that Jared will be talking quickly about Yorktown, which is going to be drilling soon. But for you guys and for most of you, I want you to understand that, Energy Funders doesn't have the resources or the capacity to really evaluate from a geological standpoint each of these projects. We're really trusting, and we know Houston Energy, who does have the resources and are very, very capable of these type projects. We're trusting their information. We have a great relationship with them. So when you look at the project, I want to make sure that you're not looking at it from a standpoint that we brought our team in to evaluate the asset to say, hey, this is all of the things that we normally do on traditional projects. So when you invest, you need to be able to invest knowing that you're listening to Houston Energy, you're looking at the documentation yourself, and you're really, really knowing that we did not do a tremendous amount of evaluation. We are looking at it from an economic standpoint. Reed has really run some great numbers on expectations, but these wells do have, a higher level of risk than our traditional assets. Now, in saying that, it's also very exciting because for a group like us and for most investors worldwide, to be able to participate with Houston Energy in any type of their projects requires usually a big amount of capital to participate with them. And with our relationships and what we've done with them in the past, we are bringing access to all of our investors. And so I want you just to note that, they are a very high caliber, we call prestigious partner here in Houston. We're real excited about being a part of them. And this is for you guys to make a decision if you want to participate or not. And we're really excited about the opportunity. So Reed, I want to hand it back over to you. Jared, thank you for being here and giving us the opportunity, and looking forward to the call.
We're offering two deals with one fundraise. And the reason that we're going to be able to get into the Yorktown, which is fully subscribed right now, 100% sold, and has a great operator, is that we're willing to jump into both projects. We as Energy Funders want to give our investors the opportunity to truly track and follow an operator's success record. Well, how do we do that? You need an opportunity to invest in every one of their deals if you want to. Otherwise, how are we going to follow their track record of success? This is just interesting because these two prospects were found off the same seismic and from the same mineral interest owner. This is a package of wells, and that's why we wanted to offer it to you in a package of investments. If you just drilled one of these, what if you drilled the one that hits and then the next well doesn't hit? We want to be able to tap into the portfolio style of investing where we take small bets across many different projects with the best investable deals. I'm just so grateful that Jared's here with us. He actually recorded 2 webinars with us last week. I know that was a drain, and I greatly appreciate that. So right now I'd like to turn over to Jared McGee at Houston Energy. He's their exploration geologist.
Thank you, Reed. Thank you, Casey. The Yorktown prospect is at 4.1 million barrels and 7.3 BCF potential. It's a stratigraphically trapped amplitude at the crest of an upthrown three-way closure on Northeast Lake Washington Field in Plaquemine Parish, Louisiana. It's one string of pipe, and it's a barge job, meaning that they're going to have to go out there with a barge rig. It's about 6 to 8 feet of water is where they're at. The TD of the well is 17,000 feet. The top of the objective is 16,325 feet. Also, this is only a one landowner. Conoco owns the fee, so that's the only landowner we have to deal with on this particular project. Are there any questions?
So the first question is, can you discuss drilling timeline for both wells?
The Yorktown project, like I mentioned earlier, is going to spud probably the end of April, beginning of May 2019. It'll probably be about between 45 to 60-day well to drill it. And it'll probably take 6 to 9 months to hook up. And so you're looking at probably December or early January of 2020 for production flowing to the tank.
So the follow-up question is, there's some PetroQuest wells in the area to this depth, and they really struggle to drill this deep. Have you ever had a time where you struggled to drill to that depth? And are there any pieces of data or offset wells that make you think that drilling this will not be nearly as problematic?
For this particular well, we're dealing with LOX, LLOX, out of Mandeville, Louisiana, is the operator here. And they're probably the best operator in the Gulf of Mexico or onshore or deep water right now. And they have an excellent drilling engineer over there who's done a phenomenal job over the years. And there's plenty of offset wells that go this deep on this particular prospect. Right here is a map of the prospect, zoomed in at 1 inch equals 1,000 feet. So you can see each one of these tops here are these wells, the Z1 here, the X1 here, the W2 over here, and the S1. All of these wells have went down to see this depth. So we have plenty of control in the area to know when we are going to be hitting pressure. So there's a lot of information in this particular prospect to know exactly where we are at and what depth we need to set pipe. That's like the critical aspect of drilling these deeper wells, is picking your first pipe point. In this particular area, we have all these wells had to set pipe to get down here, and we have that pretty well picked using the 3D seismic and the well log correlations we have. For the Potomac prospect, that well is a little bit more complex because there's not a well in the particular fault block we're drilling in. So that well does have a little more risk to it from a mechanical standpoint. And Houston Energy is operating that well. Nick Rezzavani is our drilling engineer. He worked at Marlin Oil and Gas out of Lafayette for several years, and he also worked for a company called ADTI, where he was like one of the primary drilling engineers for several wells in the Gulf of Mexico. And he's been in the business, 15 to 20 years as well. And that well, like I mentioned, the mechanical risk is a little bit higher on the Potomac prospect, just for the simple fact there is no well that actually saw the interval in our fault block. But we do know where to set the first string of pipe, which is the most critical aspect to the prospect. Setting that first string of pipe will give you a good shoe test, so you know how much deeper you could drill and what kind of pressures the well can sustain and still have hole integrity. On that the Potomac prospect, there are two wells out here, the Mecum number 2 well and the Bass number B1 well, right near the Potomac prospect that went to 16,000 feet, both wells. And so we do know all the way down to 16,000 feet where we're going to be at in the section and where we need to set pipe. So getting that first pipe point is critical for the Potomac well, and that is, we do have plenty of information to get that first pipe point picked. But like I said, once we get below 16,000 feet, we don't know exactly what we have, but we've drilled several wells like this in the past, and we're going to be cutting this large fault, this light green fault here at 16, right after we set the pipe. And so we're going to set another string for Potomac, probably around 16,500 feet, to ensure we get all the way to the bottom of our hole. And the first string of pipe in the Potomac well is going to be around 13,500 to 14,000 feet. And we have that, like I mentioned, we have two wells here that see the interval, and we know exactly where to set it. Let me show you the cross-section real quick. This is the cross-section for Potomac Prospect, and here are the two wells. This is the proposed location. Here's the Mecum number 2 on the left, and the Bass B1 on the right. The Mecum number 2 set their first string of pipe here at 13.1 pounds, 12,570 feet, and the Bass B1 set theirs at 14,100 feet, 12.6 pound mud. So we're probably going to set ours around 13,500 feet, because you can see this here is where they set pipe right at the base of the sand. They probably should have pushed it lower to about this 12,800 foot mark, which is equivalent to the same depth, around 14,100 foot in this B1. There's a lot of dip going on here, but we do have plenty of information. We will be logging this while we're drilling it, so we can correlate these wells and have it figured out. We'll also be plugging it into 3D seismic. So setting that first string is, we're going to drill down to 13.5 and set the first string right here where my cursor is at 13,500 feet, plus or minus, 100 to 200 feet. Then we're going to drill down, and right here is 16,000 feet. We're planning to cross this fault right here, and we probably will come up thrown into like a nice shale, and we're going to set our second string of pipe and then drill down to TD right down here, 19,500 feet. But this is a good representation looking at this cross section of the struggles we will have drilling this well. There's no fault in shallow. It's just this first fault. We're going to cut this large fault here around 16,400 feet, and then the plan is to set the second string of pipe right there around 16,500 feet. And like I mentioned, this first string's going to be here at 13,500 feet. Drill 3,000 more feet, and just to be safe, we're going to set another string right here.
That's perfect. Great explanation. The next question's about, similar to this, turnkey drilling, or is it day rate on both projects?
Both projects are day rate. The reason for that is that it's going to be like a 25 to 30% markup for the Potomac prospect and for the Yorktown prospect, because they are pressured wells. So you're looking at going from like an $8 million well to a $10 to $11 million well, and we feel comfortable with the operators that we have, locks on Yorktown and Houston Energy on Potomac, that we will be able to meet our day rate expectation. There's only one or two companies out here that even turnkey these wells,
So basically you're saying that we're working with one of the best operators in this area, and if we take a turnkey on top of that, we're almost missing out on the efficiencies that they can give us by being such a great operator.
That is correct.
Are there any hurricane insurances that you provide, or what types of insurances do you provide on wells like this that are in a swamp, or they're just a little more complex?
Well, for actually both these wells will be drilled out of hurricane season. The first well, like I said, will be spudded in April, and hurricane season really doesn't start till like June. So we're kind of missing the front end of hurricane season for this particular project, for the Yorktown project, because it's going to spud in April and drill probably in May, be done by June, or be done the early part of June. Hurricane season, the months you don't want to drill a well in, no, actually more like July, August, and September. Those are the months you really want to avoid. And Potomac won't be spudded till late fourth quarter this year, like December, and then January. And the insurance, you'll be covered under the operator's insurance for any like acts of God. That's part of the deal Houston Energy and energy funders have come up with, and that you're covered under the operator's insurance. And that's one of the things as we provide from our standpoint is we are fully insured.
And investors, just so you know, we also are insured for the fund. So you've got 2 layers of insurance. If you have more questions about that, feel free to email us, and we will try to provide that in the important documents section on the project page. After we drill and set casing, how long does it take to test and complete the well? And then after testing and completing, how long does it take till we're producing?
Yorktown will probably take us, we'll probably test the well within a month after we drill the well, within the next month. And like I said earlier, just because of dealing with the state of Louisiana and paperwork and having to build a pipeline and get facilities, and these wells in the marsh do take a little bit longer. They do take it could be up to like 9 months to 12 months before we are actually on production. But the earliest I've seen is like 6 months. The likely is like 9 months and then it could be up to a year, like on Potomac in particular, because we'll probably have to get a really big barge for that particular well. Yorktown, hopefully we'll be able to buy like a used barge in the area and bring it in and have it hooked up within 9 months. And like I mentioned, the Theol well was an exception to normalcy. That well was literally hooked up and producing within 1 to 2 months. And the reason that was because we ended up buying a couple wells right there next to the we ended up buying 2 wells and sidetracking out of one. So the facilities were already there for the project. These 2 wells are a little bit deeper, a little more expensive. They're on the water, but they do have a lot more upside and a lot more higher potential to make money, and the returns are a lot greater. But so we spud the well for, hypothetically, Yorktown will spud April, be done drilling by June 1st. Well, if it's a success case, we'll test it in July. Then hopefully by February, March, April next year, that's like most optimistic is probably April next year, it'll be on production. For Potomac, the likelihood is we will spud it in November, December of 2019. We will have it done. It'll probably take about 3 months to drill. So you're looking at February and March 2020 to finish drilling it. Then it'll probably take, I'm guessing, a month, maybe possibly 2 months to test it. So you're looking at April, May of 2020. Then that well will probably take, 9 months to hook up at the earliest. So you're looking more like early first quarter 2021 for first production on that particular project. But that particular project is a really big, high-impact well that has a great return on your investment.
I heard you mention we're going to have a barge transport oil. I heard you say we're going to put in a gas pipeline. What do we do with water, with produced water?
For Potomac, we would probably have to drill a saltwater disposal well, but hopefully that's several years away. And for Yorktown, there's a saltwater disposal well in the area, and we'll probably try and tap into that well. The good part about Potomac and Yorktown is that they're both near pipelines, so the actual hookup cost will not be very high. And that could expedite some of the hooking it up, as well as that both projects are near production or near pipelines. Like Potomac is kind of out in the middle of space, but there's like a Chevron line and I think it's a TCP line that runs like 1,500 feet of both lines run about 1,500 feet away from the proposed location. So that really should help expedite the hookup of both projects, or for the Potomac project. And then the Yorktown project, there's several wells out there that produced. We're actually we're actually drilling from the surface location of a well, the X1 well, and drilling south to our target location. And so we're directly next to some lines right there for the Yorktown project.
I remember we said something, I think, on the Potomac project about why these complicated, kind of off the beaten path prospects still exist. So maybe you can just say it again or walk us through it again, like why all the easy projects are picked off, but these projects that are complicated and those still exist. Does that make sense? Yes.
These particular 2 prospects were found on the same data set as Reed mentioned earlier. It's a proprietary data shoot. We, as a company, struck a deal with one of the large landowners in the area to get the 3D seismic. And in doing so, we are one of only 2 companies I know in Houston that actually have this data set. And so that gives us a competitive edge. The other company out there owns a large major field. And when I saw their data, it did not look reprocessed to me, because we did talk to them as well. And they did not reprocess their data. We actually go back and reprocess the data, clean up the gathers, repick velocities, and go back to the field tapes of the data to get the best image we could possibly get. And so we're able to see these large, deep structures that no one else is able to see. And the key here is we were one of the first people with the data set. And that really helps out a lot. And you're able to find these larger projects that no one else is able to get.
Let me just piggyback off that and just kind of say that if it was easy to find and if it was really, really simple to get to, I know we're going to have to dredge a channel to get to both of these projects. And if it didn't require barges and if it was onshore, we're pretty sure this would have already been drilled. I mean, the reason that this exists I mean, people have looked at this before. People have mapped this before. I remember you saying that in the presentations. It's just tough to get out there and do this. So I think the follow-up question is, who are the major players in both projects, and what did they like so much about the projects?
Locks in particular is one of the major players in the Yorktown project. They like the fact you're getting directly up dip of an oil well. You're about 100 to 150 feet directly up dip of a well. We've had several engineers look at it to confirm that it is water drive and not depletion drive. So we feel very comfortable that there's still reserves there remaining up dip of the X1 well. And we've had several engineers, they've had several engineers to confirm that there still should be good pressure there for the project. And that one's a pretty lower risk prospect, Yorktown. And that's why we're have to give some of our interest up to let y'all in that one. The other project, Potomac, some of the companies, Cathexis is one of the major players in that project. They were in the Thiol discovery as well with us. They really like the geophysical aspect of it, and the fact that it is one of the few, it probably has one of the best ROI chances in the entire Gulf of Mexico. That's including deep water wells. So one of the best possibilities to have a large geologic discovery and return on your investment. It has one of the highest return on your investments in the entire Gulf of Mexico that they've seen. But the geophysical aspects of the prospect, the fact it's a four-way closure with an amplitude that conforms the structure, really helps reduce the risk to the prospect. And that, it's just a really great project.
And the next question is, who owns the minerals, and are these terms of 27.5% common in the area?
The reason 27.5% is common in this particular area is because Conoco owns the minerals. Conoco, the major company you hear about in the news every day, they're on the west side of Houston. They do not negotiate. Their terms are 27.5% to get their leases. And dealing with the major landowners in the South, like South Louisiana in particular, Conoco is one of the largest major landowners in the entire state of South, or the other entire part of South Louisiana, and that's just their standard deal, 27.5% royalty to them.
Wow.
Most places we could get like if it's onshore, like in a land, if we're say in a town like Houma, for instance, and we're dealing with some local people that are not a major company, we could probably get like a 20-21% royalty. But when you're dealing with a major company, Conoco just has their set deal, 27.5%, and that's what it is. Take it or leave it. This particular project, we do have some. For Potomac, we have state acreage and Conoco acreage in the project. For Yorktown, it's purely Conoco acreage. So on Potomac, you're actually going to get a relief on the royalty, because they'll blend the royalty between the state and Conoco. And I can't remember. I think it's like we paid a 21% royalty, I believe, to the state for Potomac, and a 27.5% to Conoco. They'll have to go to court, Conoco and the state of Louisiana, to figure out how much they each actually own, because there's a portion that's clearly Conoco, there's a portion that's clearly the state, and there's a portion that's kind of both of theirs, and they're both claiming it. So they'll have to go to court and figure that out amongst themselves. This is very common in South Louisiana. It happens all the time between these large landowners in the state of Louisiana, where they go to court and then they figure out the royalty difference, and then the money for what they'll do is they'll escrow the highest royalty. So they'll escrow that 27.5% for that portion of the land until it gets figured out in the courts who owns what. So it's not like it's going to be, they're going to take all the money from that third of the project and hold it. They're only going to keep that, we would normally pay for a royalty, and hold that percentage only.
So this is regards to the Yorktown. The amplitude seemed to be much brighter on our prospect than the X1, but yet, the X1 was drilled first. Why exactly do you think the X1 was drilled and not the Yorktown first?
You can see the X1 here. It was drilled in 1964. They did not have 3D seismic in 1964. This survey was not shot until the late 90s, to 1998, 1999. And So for them, they probably had maybe I'm not sure if they even had 2D. They might have had like gravity data they were using back then. They might have had 2D lines they were using, and they saw a big structure here in the upstream side, this big fault, this light green colored fault, and they were kind of drilling, and they got very fortunate to find some hydrocarbons, because you can see in a lot of these areas, you'll see a lot of older wells that were drilled in the middle of nowhere, and they didn't have anything to image. They had like some type of like gravity image or something that made them believe that there might have been something there. And back there in the 50s and 60s, when they drilled a well, like if you drilled 1 out of every 4, that was really, really good. In today's world, we're hoping to drill 60 to 70% of our wells be successful. So the advent of 3D seismic in the 90s and 2000s has really helped increase the success. And picking these locations, like a 2D line, you might only have a couple 2D lines that cover this thing, whereas 3D, you're able to image the whole entire project. And with the 2D line, you might only see a portion of the prospect. And so they drilled those, and they did an exceptional job when they did the 2D lines, but the 3D has really given us a clearer vision of the entire picture of what's going on in the subsurface.
This one's a great question. It's, typically we're paying $2 to $3 million for these onshore wells that are going to, 10 or 12,000 feet. How much do you think the average price for both of these wells all in? Kind of like a P50 case.
The all in for Potomac is going to be close to, I think it's $18 million, a success case. And I think Yorktown's close to $10 million. So the all in cost is going to be about $28 million for both projects. If they both work and they're both successful, it's going to be about $20 to $30 million. We're searching for $1 billion worth of product.
Yeah, I like that number. If you kind of look at both projects together, it's hard to describe. So hopefully I'll come up with a cool graphic. It's going to be complicated exactly how we decide to raise this money. Do we just raise dry hole costs for both wells, or do we add in some money for completion? We're going to figure all this out, and it will be presented on the project page. But just so you know, that's kind of how we're thinking about this raise, is how do we raise the smallest amount of money so that it's sitting on the sidelines for the least amount of time, but yet we can participate in the dry hole costs of both wells. And if we are successful on the Yorktown, which would be great, we're probably not going to see checks until we're already drilling the Potomac. So a cash call would then be imminent. So that's what we're going through in our head at Energy Funders, of how to balance all of this, how to make the most capital efficient use of your funds. Because if we do have capital sitting on the sidelines for the Potomac for an extended period of time, 8 or 9 months, then it'll just be in a low yield savings account accruing about 2% interest. So just so you know, that's kind of what we're thinking. And thank you for that answer. That was really good.
Also, those wells you're drilling in the non-pressured section onshore in particular are anything that's considered non-pressured, which means you don't set an extra string of pipe. They're usually cheaper wells to drill. That being said, in the non-pressured section, the amplitude play especially is a little bit higher risk. You're looking at more like a 50% chance of success, whereas like the deeper when you're drilling these deeper amplitudes here that are pressured in like a 15 to 16 to 17 pound mud environment, the success case is much higher. They're more like around a 60 to 70% success case. You will find hydrocarbons and the higher pressured drilling. So you're actually reducing the risk by drilling the more expensive wells. I know it's hard to fathom. You're spending more money, but the risk is actually being reduced for the fact you are drilling deeper into a higher pressured regime. Whereas like in the non-pressured section, the amplitudes are a little bit more risky.
That makes sense. You could easily get a false positive. That makes perfect sense.
That is correct. There's fewer false positives in the pressured section than there are in the non-pressured section.
Okay. Can you describe what the production facilities will look like and how much they'll cost?
The production facilities, I believe, for Potomac are probably going to be around. This is not my area of expertise. I'm guessing $3 to $4 million. It's like I said earlier, it's going to cost about $12 million to drill it. I think the number we had was $3 million to $2 to $3 million to complete it, then an extra 3 to 4 to hook it up, get it completely hooked up and flowing. And they're going to be, for Potomac, it'd be a very large facility because that particular well ought to flow between 20 and 40 million a day and hopefully a couple thousand barrels of condensate per day. For Yorktown, it's going to be a little bit different. That well, we expect to flow around 1,000 barrels of condensate per day and have some associated gas, like maybe 2 to 5 million a day, which we put in a gas line. So we got to have enough. It's going to be a barge rig out, our barge kind of production facility, and have plenty of tanks to hold all the oil for at least a couple days. So they're going to be pretty good size projects that need a lot of room to store condensate because these are very big wells, and that these will be these should have very large facility. Let me I actually have a picture. On another project. Let me look real quick, see if I can find it, if that's okay.
Yeah.
This right here is actually a picture of a barge, like a production facility out in the marsh. This was for a Bayou Barataria prospect I had. It was making like 1.7 million a day and about 400 barrels of condensate. This is a facility Manti operated, but it might be around twice the size of this for something like Potomac. But it'll look very similar in style. And what we'll have is you'll see these tanks up here on the left. You're going to have a lot more tanks because that's where you're going to hold all your oil. And you got to have plenty of tanks to hold oil for a day or two, because what they'll do is they'll come out and get these and ship and barge this back to another location. But it's pretty interesting looking. There you go. This is them installing some stuff out there. But you can see these are the barges on the marsh in the like South Louisiana, for instance. That gives you a little bit better. There's another picture of the facility. So it'll look something similar to that. It's pretty good size. I mean, these are pretty big projects.
On the Potomac, where does the 11 million barrels come from? Are all the wells in the area seem to be about 3 million to 5 million? So where did the 11 million come from?
Let me go to Yorktown real quick.
Sorry, that was for Potomac. I don't know.
Yeah, but let me go to Yorktown to show you why we're getting that number from. The size of we're getting the recovery factor for Potomac from Yorktown. The recovery factor we gave was 50 barrels a million, because there is nothing out here that is gas that is really like considered a gas well in this particular interval for Potomac. Everything up here we have tied to is all oil. Even the well for Potomac we tied to the east called the Peltex well, it made 1.1 million barrels in this particular interval. If Potomac were a complete oil prospect, it'd be about 38 million barrels. But we're guessing because of the amplitude strength, it's a hypothetical, it's kind of like, it's more of what we believe based off the amplitude is going to be a gas condensate amplitude. And 50 barrels a million is a pretty good estimate because there is so much liquids in the area from the field to the north up here at Yorktown. Up here, there's this particular fault block to the north made about 3 million barrels. This right here made 3 million barrels. Out here made 300,000 barrels. There's another well out here that made another 3 million barrels. So there's basically all condensate and oil in this particular interval. But just based off the AVO response, we did some modeling for Potomac, and it's shown us to be more of a gas condensate reservoir than oil.
The question is, so let's say we hit our like P50 case. What are the expected returns for both projects?
For this particular project, if we do that, would be more like 1 million barrels, I believe, for the Yorktown project. If you just say, you take one objective and you say risk it, it's going to be about 1 million barrels. Because you can put 2 million barrels in there, but you're going to basically risk it by like 50%. So you're looking at like a 1 million barrel. 1 million barrels is what you use as your estimate for like the P50 case.
And this is Louisiana, so you get a different price than West Texas or Permian or whatever you're hearing about.
That is correct. You're closer to the Brent price than you are the West Texas price. It's Louisiana sweet, and it's about a $4. It's actually more like $5 bump from West Texas and So you're getting about $5 to $6 more per barrel in Louisiana than you are in West Texas. And for Potomac, like a P50 case would be, you basically take 50% of what you believe it to be the size of it. So like this one, if you're trying to size it, what a lot of people would do is they'd take kind of this red area here and give that a higher percentage of working. Say that red area is about 200 to 225 acres. And you would say that's going to make about 60 BCF and 3 million barrels for your but a P50 case would be close to like 50 Bs, I believe, on this particular prospect. So if you take just that red area, you're looking more like about 60 Bs and 3 million barrels, roughly, for like a P50.
Yeah, I just ran some quick economics. So basically what happens is if you run those numbers, you get about a 4 or 5x on the Yorktown, and you get a 10x on the Potomac. And so that's exactly what, when we were talking about the large interest owner in Potomac, I mean, to take, well over 50% of the deal, you obviously would spend a lot of time assessing the project. We talked about that on the webinar. And, I think you said it best, Jared. You said, look, there just aren't these types of return potentials out there. They've either been drilled, or they're just too risky, or there's not enough information. And so for someone to take that much risk upon themselves, they must have seen a nice reward potential. And so if you start, hitting these numbers really hard, like I'm hitting them, 3 million barrels and 50 BCF, which seems like an incredible amount of volumes. It really is. But just based on how big the anomaly is, I mean, 500 acres of anomaly is just crazy. Maybe you could just quickly, what did we end up finding at Theol for reference? I mean, it's probably an 8 to 10 BCF well. What were the acreage and footage on that?
I think the original numbers, we only ran our numbers based off the Planning Line of One Sand, and like the upside potential was like 17 BCF, and it's looking more like it's going to be, most likely scenario is probably going to be like 7 to 10 BCF. So you're looking about half of, like, the max case scenario is 17 BCF, and the most likely is what we're going with right now, which is probably 7 to 8 BCF is probably what we're going to end up with at Theol for the most part. So the high side case scenarios are what I showed you, which was about 17 BCF in the Planning Line of One Sand, and it's going to turn out to be around 8 BCF. So similar here, we're looking at this particular project. For this one sand here, we have two objectives here. For this one sand here, it's looking about 180 BCF and 9 million barrels. But if you just kind of, for instance, comparing it to Theol, you just take, say, 60 BCF and 3 million barrels is like most likely. This 183 BCF and 9 million barrels is like the most optimistic approach you could take. A bit more conservative approach would just be to take the red outlined area and say it's going to be about 60 BCF and 3 million barrels.
Go ahead,
the hardest thing for me to gauge, Reed, in this industry is the barrels condensate per million return. I mean, that is very hard to gauge. It could be 100 barrels a million. It could be 30 barrels a million. You just don't exactly know until you drill the well and you test it.
Which is fair. I mean, that's why, not everyone drills these wells. I mean, they have a degree of risk. Not everyone has this expertise. Not everyone has this access to capital. But this is exactly the type of project that we feel we should bring to your everyday investor that is accredited and is looking for these types of returns. So yeah, I just want to thank you again, Jared. We've got one last question. How do you assess the probability of success for these wells? And what do you think are the probabilities of success for both wells?
I believe the Yorktown prospect's probably like a 50% chance of success. I think it's most likely going to make a well and be a commercial well and give a nice return. Potomac is probably more like a 30 to 35% chance of success. It's a little bit deeper. It's a little bit more unknown, and it does have a higher risk because there is no sand to tie to directly in the fault block. But those are pretty accurate numbers based off, all the people I've shown the prospects to. Yorktown may go a bit higher. Potomac's probably a 30 to 35% chance of success, but Yorktown's 50% and Potomac's a 30 to 35% chance of success.
And I think just for reference, we had Theol at Well, we had the Planulino was obviously there was an anomaly. So I think you're giving that 50 to 70% at the time. I went back and watched that presentation.
That's correct. And so like if you take that number I gave you, 17 BCF and risked it like 50%, the way people do risking, you're risking like your risk reserves are like 8 BCF on that particular prospect, and that turned out to be what it ended up being, was the risk reserve number for the alt project.
I mean, even if we drilled the Potomac and it was like the X1 well down dip of the Yorktown, I mean, it's still very economic. I mean, 3 million barrels is, that's what I like about it is, look, there are a lot of wells in the area that have produced out of these sands. There are a lot of wells especially on, the Yorktown, just tied directly to, they've drilled nearly this deep. With Potomac, you don't have the exact offsets, but you have a few dry holes that went down to 16,000 feet, so you feel comfortable to that depth, but no one did necessarily push further than that. So any final remarks or anything for us, Jared, or anything else we missed?
No, I think we've covered most of it. And I think we will definitely, I think Yorktown has a really, really high chance to work, and it's going to be spudded very soon. I'm very excited about it. And Potomac is one of those things, it's a rare animal that you don't get to see very much in this particular industry. You will not get many chances at another prospect like this, and from what I've seen. For this type of return on investment, this type of size, these are rare to find prospects of this magnitude.
Well, thank you, investors, so much for being here today. Your questions truly make events like this successful. I could not have thought of these questions myself. I would truly need the crowd to come up with this information. So thank you for being the private group of investors that got to see this today. We're looking forward to bringing this to the platform. Just so you know, investors, please review the project page for the disclosure memorandum, the participation agreement, all the other legal documents, the technical data. I want to thank Jared McGee for being here from Houston Energy, a great partner, and it's exciting prospects. So thank you to everyone, and have a good day.